Well, good morning. This is Rich Morrison, and thank you for joining this month's afterMATH webinar. First of all, I want to start out by saying thank you to all of our veterans. We certainly appreciate everything you've done for this country, for the lives we're able to live. And I've got a daughter that's recently become a veteran, so it certainly hits home even more so. So thank you, thank you, thank you. With that, we'll dig into this month's afterMATH. We've got some hot markets that I want to start out with here this morning. And the first one is the Bitcoin market. Bitcoin gapped higher this morning. To be quite honest, I've yet to figure out exactly what Bitcoin is, but certainly it's recognized as a currency, and it has really taken off, especially since the election. So big move here this morning. The second one, the S&P, the stock market continues to soar. You can see here this chart. I've got it going back to the beginning of the year, and that we've gained what, a 30+% since the beginning of the year. So topping 6,000 at the end of last week and making a new high here this morning. And then thirdly, the palm oil market, which in ag is the closest we can come to a hot market right now, but palm oil futures certainly on fire, seeing some tremendous demand overseas. And that's helping the soybean oil market, which is helping soybeans. And even though I continue to say that I think soybeans have the worst looking balance sheet at the moment, this palm oil rally has certainly been a help for it. So looking at the markets right now, the biggest factors that I see, certainly U.S. stocks continue to be a burden on the market. Now that said, we did see corn and soybean stocks get a little bit lower in this report on Friday. We'll talk about that here in a few minutes. South American weather and what the crop looks like. They were late getting the crop started planting. A month ago when we had this meeting, they were slow getting the crop in the field. All of a sudden that has flipped, and now they've gotten a lot of beans planted quickly, gotten some rains. That's been a very big help. We'll talk about that. The funds have been very active, covering their short positions and even going long the corn market now. And so we've been waiting for that to happen for 4 or 5 months. Finally did, and it gave us some higher prices. And then lastly, the macro influences. We're seeing this in the oil market, the dollar, gold market here today. Holy cow, the stock market again making new highs. So a lot of these other markets, and they tend to swing a lot of our markets. Whether, when you see a strong dollar, it tends to be negative for the commodity sector. The oil market tends to kind of pull the commodity indexes. And so let's start at the last one of those and work our way back. The dollar I mentioned just a minute ago, but the U.S. dollar firm again this morning, up over 105.5, trading the highest it's been since summer. A lot of this happened since the election, and if you look back at election day, the following day is when we gapped higher in the dollar and continued to push higher. So people are showing some confidence in the United States, confidence in the dollar with the buying there. Now, the offset to that is foreign currencies. You're seeing currencies like the Brazilian real trade to the lowest level that they've ever traded versus the dollar. The euro is trading weaker. The yen is trading weaker versus the dollar. And the impact of that is, especially with Brazil, it's making Brazilian beans a lot cheaper versus U.S. soybeans. And so that's something we're going to be certainly paying a lot of attention to in the markets. The oil market I mentioned a minute ago, I think that there's a belief out there that crude production is going to pick up. We're going to pick up, whether it's, however means we're gonna increase U.S. production of crude, and that's going to be bearish to the market. And here this morning we're down pretty sharply in crude oil, down almost $2 a barrel. You can see technically the RSI stochastics turning lower. Probably not a good sign. We'll watch this $70, $69.50 area here today if we're able to hold that or not as we go into the close this afternoon. And the impact of oil is a couple of things. It tends to be really a driver for the commodity index. If you look at the Goldman Sachs index, it's made up about 30% of crude oil futures. And so when crude's however crude trades, it tends to pull that index and pull a lot of the commodities with it. And I thought this was a great chart from Susan Stroud comparing crude oil to corn futures over the last 10 years. And it's amazing to me that we've tended to see those two track so well together, despite them having different fundamentals at times. And so I think it just goes to show that, well, number one, that corn, roughly a third of what we produce is fuel, and so it is a fuel similar to oil, but that the two tend to track so well together. I mentioned South America a minute ago, and as of last Thursday, Ag Rural reports that they are 67% planted on their soybeans, which is now ahead of last year and ahead of the 5-year average. And that has turned quickly. This is the state of Mato Grosso. They're up to 93.7% planted. That's amazing how they've planted so many beans fast. And you can see you're back here the end of September, October, they were well behind the 5-year average, and all of a sudden, holy cow, they've caught up. And so the weather has changed down there. They had gone from extreme drought over the last several months to now where they're catching some pretty good rains across this part of the country. And even though it's been raining, farmers need the rain. They've been planting between showers. Here's Mato Grosso, the big state right here in the middle of Brazil. Pará to the south. They're the biggest producing bean states in Brazil, and they've caught some pretty good rains. And if you look at the forecast, much of this same area is expected to continue to get some pretty good rain over the next 7 days. Now, they are going to miss out to the south, so we'll watch that a little bit. This is the area where they're starting to plant a little bit more now. They start in the north and work their way south into Argentina. So they had been wet earlier. So all in all, probably pretty good conditions overall in Brazil right now. We mentioned the funds a little bit ago, and it's been an amazing run. How they've taken their net position from a record short here in ag commodities in August now to the long side of the market, how quickly that has happened. And peak trading shows this chart, shows a lot of the reasons why. Certainly dryness in Brazil was a big deal, certainly the Chinese stimulus, but a lot of this has just been, the funds, I think we're tired of being short. We've seen some good demand. They do mention exports on here, export demand for corn, soybeans, the palm oil market, et cetera. All of these factors in getting some buying done. And then the last thing I'll mention before we get into the crops are Friday's production numbers from USDA. And they did lower the corn yield by 7/10 of a bushel, took production down 60 million bushels. On soybeans, they lowered 1.4 bushel per acre. That was a bigger drop than expected and certainly was bullish to the bean market on Friday. Took production down over 120 million bushels. So all in all, the report was fairly friendly on the U.S. numbers. Now, at the world level, nothing changed. Nothing really to write home about here. We're just getting into the planting season again, so no reason to want to change those numbers. And when you look at the impact on stocks in the United States, USDA lowered corn stocks 61 million bushels, took bean stocks down 80 million bushels, which on the surface would seem bullish, but again, that's a big, big number we're starting with. At the world level, corn stocks down over 2 million tons, bean stocks down 3 million tons, wheat stocks virtually unchanged in that report. So let's dig into soybeans. Bean oil, this is the biggest thing going on in the bean market right now. I showed you palm oil earlier, soybean oil here today trading above the July peak. So this has been one whale of a rally. And even though I've continued to say that I think beans have the worst looking balance sheet out there, this veg oil market rally has certainly been the factor that has helped pull beans up. Now, the offset to the oil market going up is meal going down. Because what happens if you overproduce or if you raise production of soybeans to get oil, you end up with too much meal. And so meal stocks have started to build up, even though we've had this good demand for oil. And, this is a good thing for hog feeders. But so which way do soybeans trade? Do soybeans follow the oil? Do they follow the meal? And I think they've struggled with that here in the last couple of weeks. We've seen different days where they've gone different directions. But this biofuel situation in soybean oil in particular is pretty interesting. You look at how that's really grown over the last couple 3 years versus corn ethanol, basically being fairly flat on the demand side. But so to take advantage of some of this demand, and because we haven't got these soybean plants up and running quick enough in the United States, we're starting to see this huge import market for used cooking oil coming out of China in particular. You can see that on the chart on the red showing the last 2 years, how much used cooking oil is coming out of China to meet this domestic demand for oil, fuel oil in the United States. And so the impact of that has already been seen because you can probably remember over the last year, we've talked about the number of soybean crushing facilities being built in the United States and how there were a lot of them that were still yet to be built that were going to come on over the next couple, 3 years. I've seen recently 3 or 4 of those now are being scrapped at this point because of the profitability or because of this import of the used cooking oil. So this is a story that's yet to be written. I think there's still more to it as we go forward. But just kind of shows you what's been happening as people try to take advantage of the market. So looking at the soybean report from Friday, USDA did lower the yield I mentioned down to 51.7 bushel per acre, so no longer a record, a couple of tenths below what we had in 2015. And you can see by state, again, the red and the pink states got a little smaller, blue states got a little bigger in this report. Still some record numbers out there: Michigan, Illinois, Indiana, New York, Arkansas, Mississippi. But you can tell, the darker the red, the more cuts that we saw in this report. And this is a neat chart that NASA puts out as well, USDA shares, showing where the hot spots or the yields were this year. And so the darker the blue towards purple, the higher the yields were. So production-wise, production basically matching the record we had back in 2021. Even though the yield's down a little bit, we had more acres this year, production at 4.46 billion bushels. And that number was below what the trade was looking for. You can see the blue dots represent trade estimates and amongst a bunch of analysts, and the red was the actual. And so because that number came in lower than expected, it was friendly to the bean market when that report came out on Friday. And so looking at the balance sheet, USDA did make a couple of other changes. They did, I mentioned, lower the yield, took production down over 120 million bushels. They did offset that a bit by lowering the crush and by lowering exports. And so at the end of the day, ending stocks were down 80 million bushels, which is good for the market, but still it's the highest number we've had in several years. And so ending average farm price was not changed. They kept that at $10.80. So looking at the stocks to usage compared to farm price, this I've shown this for well over a year now, and we continue to mimic what happened a decade ago. When we had record high price, you saw an increase in production, you saw an increase in acres, et cetera, increase in stocks. And so as stocks started to build, prices came down. And that's what continues to happen now. And even though this stocks number is not as big as last month, we're still seeing the impact of lower price. So going forward, it's going to be interesting. And again, these are just U.S. numbers. If I were to plug world numbers in, it starts even looking a little bit uglier. And so when you look at, to me, the big story continues to be South America and beans. Even though the U.S. and red got a little smaller this month, USDA still forecasting a record crop in Brazil, forecasting a big crop in Argentina this coming year, and total production in the big three would be still 128 million tons higher than last year's record. And so, there's still some room here to play with, but if they grow these size of crops, look out, we're still looking at possibly swimming in beans. And so, this is another chart that I thought was interesting that Susan put out showing the growth in the Chinese imports of Brazilian beans over the last 5 years compared to U.S. We're not seeing near the percentage growth as what we're seeing out of Brazil. So we're the residual supplier. We're going to have our window. The October to February window is when we count on to be able to make those shipments. And so the other side of this, Brock put this chart out showing stocks to usage at the world level and ending stocks, and right now forecasting a huge jump from this past year. So we'll see what the size of that crop is in the southern hemisphere, but that's going to be the determining factor in the bean market, really over the next 6 months. And so looking at world US numbers, US number getting bigger, the world number getting bigger. So at this point, the balance sheet to me still looks bearish at the world level for soybeans. So the funds, what are they doing? Well, they're still short beans, short about 70,000 contracts of soybeans. Um, Typically, they tend to lean on the long side this time of the year. So for the last almost year now, they've been on the short side of the bean market and recognizing what we're talking about, that the stocks to usage ratio and that balance sheet is bearish beans right now. But we've had this influence from the veg oil markets come in. And if you look at the fund position in bean oil, they're long over 60,000 contracts as of last Friday. Soybean meal now, they're back on the short side of the market. So again, we've got this tug of war going on with soybeans themselves actually kind of caught in the middle. And so you can see the impact of the fund buying and selling. But funds had bought back quite a bit of their short position, and from August into early October, rally beans over $1 a bushel, sold off $1, kind of made a double bottom, it looks like here on the chart, and now they've nudged back higher again. And so the question is, how can we finish today? How do we finish the week? So far this morning, they had failed to break through the 100-day moving average for the second straight day, kind of backed off of that here mid-morning. So we'll see how they finish the day. If I've got old beans to price, I like taking advantage of this rally again. They had the RSI pushing up into the low 60s, stochastics into the low 80s. It's a good opportunity to take advantage of a higher market and the fact that we're 60 plus cents off the low again, and we've kind of stalled out for now at the 100-day moving average. So if you've got good basis levels, which I think in many areas we're seeing right now, because of harvest being over, good opportunity to be pricing some beans. If I want to hang on, the next target's probably 1087, this late September high, and then the 1112, which is the 200-day moving average, somewhere up around that $11 mark, probably be a great place to have a target in as well. Looking ahead to new crop next year, a couple of things going here. I think we've got a double bottom, kind of like we did in the nearby soybean futures, down around the 1015 area. We've kind of got a downtrending top. So if you draw these lines, now you're down around 1080, 1090 as far as the top side goes. But for the moment, this 100-day moving average, the purple line, has kind of been a lid on this market. So and we seem to be kind of hunkering down in between these moving average lines. So we'll see how we finish the day, finish the week. 10.50 to $11 though might seem like a pretty good sale this year because if we're looking at, that carry out at the world level as big as it is, depending on what happens with the U.S. acres this coming spring, you could certainly print a 9 back in front of this bean market again by next fall. And so I do want to be fairly aggressive pricing beans on rallies here this year. Switching over to corn, I think we found the key to the corn market, and that's to sell it in bags as deer corn. Almost $7 a bag. That's a pretty good deal. So pretty, we missed out on, if you missed out on $6 corn a couple of years ago, we've got an opportunity. It's just hard to get a lot of it sold for deer. But that said, the big story in corn has been export sales. Over the last 3-4 weeks, we have finally seen sales pick up. And, you always talk about the cure for low prices is low prices, and the cure for high prices is high price. And we've kind of seen the cure for low price. You've seen Mexico. Now, they're always a buyer, but they've bought a lot of corn. You've had unknown, which nobody knows. Is that Mexico? Is that China? Possibly. Somebody's coming in and buying some corn. Japan's bought a bunch of corn. South Korea's been buying corn. So, but people have been very aggressive, and you can see that here in this blue line on this chart from Brock that, all of a sudden, compared to last year, we're running well ahead of last year's sales pace. And so that's been a big positive, and it's been something to bring the funds back into this market as good buyers. Now, USDA did not adjust their export number. We'll get to that here in a minute. They did lower the yield in this report on Friday down to 183.1. So still a record, just not as high. You can see which states have changed. The pound sign represents a record, and so still a lot of record states, but the red and the pink went down a little bit from last month. The blue states got a little bit bigger. And this NASA map shows, again, where the biggest yields are across the country this year. Production at 15.1 billion, no longer a record, but pretty close to last year's record. So, we've had back-to-back really good crops. That number on Friday was at the lower end of trade estimates, so it was a little bit supportive to the market when the report came out. And if you look at the corn balance sheet, the good and the bad, I think the bullish part was this drop in the yield, which took about 60 million bushels off, but USDA did not raise the export number like many thought. Maybe they're already thinking that's factored in. Maybe they think that the buying will slow down, that it's very front loaded in the marketing year, whatever the case is. Still, demand at 14,990 is a record, and that's nothing to sneeze at. The problem is still that we grew 15.1 billion bushels, so ending stocks are expected to be over 1.9 billion. Now, you could say, well, it's less than two. The two looked really ugly, but it's still a lot of corn. And so average farm price estimated this year at $4.10. That did not change. And again, looking at the stocks to use to farm price chart, like I showed for beans, I've been showing this for a while now. This red number got a little bit smaller in this report, still though trending towards higher stocks and lower price. So the question is, will we continue to work price lower? Does price need to go down to try to stimulate more demand going forward? Probably depends on the size, of course, of next year's crop. So the positive in corn might be at the world level. World ending stocks to usage continues to work a little bit lower. We've had some weather issues in Asia and Europe that have maybe taken the top off some of their crops. So while the U.S. stock situation continues to get more bearish, the world stocks getting a little bit on the better side. I thought this chart was interesting to share. I'm not sure what it tells us as far as the market goes, but to see who's holding the corn at the end of the year, that China is expected to hold 68% of the world carryout at the end of this marketing year. That is incredible to me. And I don't know where those corn stocks are being held at. Don't know if those are in people's homes and in burlap baskets like we've seen pictures of on the internet in recent years or what. But I think it's very interesting that China is holding so much grain and that the U.S. is still the biggest residual exporter, but how much is being actually held in Chinese hands. So the funds, we talked about this earlier, but the funds have had a remarkable turnaround from the beginning of July when they were record short, nearly 400,000 contracts of corn, to this Friday when they're long. First time they've gone long the corn market in 66 weeks. Got to go back to last August of 2023, right here in this red line, the last time that the funds were actually long corn. And so I guess that tells you that they've got a little more optimism towards the market. But that said, we were all counting on when they were so short that if they bought this back, it would give us a heck of a rally. Well, yes, it kind of did. The problem is that we had huge farmer liquidation of old crop corn at the end of the summer, and then you've had a harvest that we've seen more selling as well. And so, yeah, the market has given us opportunities. You can see here in August, we rallied 50 cents. Would have been a lot more if it wouldn't have been, if not for the timing and the fact that farmers sold a lot of corn into that. Now we sold off a little bit into harvest, bought it back again, but almost looks like a double top type market up here around this 450 level in March corn. And then here this morning, we're trading a little bit lower again. So technically, it looks kind of ugly this morning because the RSI turned lower. The stochastics lines look like they want to cross going down. And if that's the case, you could see a little more selling here yet in the next day or so. So I do think that 450 area, give or take, is probably going to be tough resistance going forward. I do think this 430 area down where all these moving average lines are at, probably going to be pretty good support for this market. And so I would expect us to probably trade in that area, maybe 430 to 445 here over the next several weeks until we get something else become a market factor. What might that be? At this point, probably South American weather. Keep in mind that the majority of their corn gets grown following soybeans. So they were late getting started planting beans. They've caught up now, but that early bean harvest may not be as early as normal. And so maybe that means a little bit later planting, which pushes some of that corn into some of the dry window down there. So I'm kind of grasping for straws, but that might be your next best chance of a rally in the corn market would be something coming out of South America. Looking ahead to next year, 430 to 450, kind of seemingly holding December corn as well. And so you can see where we've been. We're hovering right around these moving average lines in the 440s here this morning. I don't really see a reason one way or the other why this market needs to go up or down, although the technicals look kind of bad here this morning with the RSI turning lower and the stochastics looking like they're going to cross lower as well. So not a good look, and we'll see where this market continues to trade. That said, I think this 450 to 460 area, probably a good place to be selling some corn for next year. Good place to start hedging. Get up close to this double top. I think I'd want to be starting to sell 25, 30%, get something on the books just in case we see an increase in acres. We'll talk about that here in a few minutes. The wheat market, wheat has been a kind of a tale of two things going on over the last 3 weeks. You go back a couple of weeks ago when USDA issued its first winter wheat ratings of the year, 38% rated good to excellent. That's the second lowest we've had in the last, 40 years. And so that was bullish, the wheat market. But since then, we've seen some rain, especially in the in the southern plains, in winter wheat country. Hard red winter wheat country has seen a big influx. The drought monitor has seen an improvement. Since then, we've started to see more rain slide to the east as well, but some of that area had already been receiving some decent rain. So all in all, we've kind of taken the weather story off the table for the moment in wheat. And so it was the kind of the story that got the wheat market fired up. It's kind of the story that has kind of gone away right now. As for Friday's report, USDA just made a couple little bitty tweaks to imports and food usage. Ending stocks, call it a negligible change, 815 million bushels, still a big, big number. Average farm price dropped a dime to $5.60. Thought this was an interesting chart that I found from USDA showing wheat exports by class. Certainly hard red spring wheat, hard red winter wheat are our two big ones, but the spring wheat, most of it all goes for human consumption. Hard red winter as well. Those are our big ones. You can see soft red is kind of the extra wheat, if you will. So we end up holding a lot of extra soft red wheat here in the United States. Some of it gets fed in the U.S. as well. But looking at the world balance sheet from Friday, USDA made a few small tweaks in the production side. Probably the biggest one that was negative is that export demand was dropped over 1 million metric tons, which tells us trade is down. And I'm assuming that's coming out of Ukraine and Russia. But from a positive note, world stocks to usage, 6 straight years we were working lower. And so that's not a negative for wheat. And at times we seem to trade that world situation. At times we've seen the market trade the Russian situation with exports expected to drop off year on year. This is the third straight year they're looking at a drop in production. And so you've seen now, exports seem to top out and they've started to drop a little bit. So that has given the wheat market a little bit of a boost at times and kind of differentiates the world situation from the U.S. situation. Whereas U.S. stocks continue to grow, the world situation continues to see a drop in stocks. So depending on which one you want to look at on a given day, that seems to be moving the market. But seeing what the funds have done, they covered a big chunk of their short position in wheat like they did in corn, and now they've been just pretty steady over the last several weeks, still short about 30,000 contracts of wheat, kind of middle of the road for where they typically would be this time of the year. You can see, though, that the buying that they had from late August into early October, gave us a dollar rally in this market. I think a month ago at this meeting, we talked about this 650 area being a good sale. And now we've dropped back below $6 again and making a new low here today. So the technicals look bad right now. I don't want to be a seller at the moment. I do think I would probably eye the blue line, which is the 200-day moving average, somewhere up around 630. I would probably want to have some offers working up there in case this market's able to flip around. Very similar looking charts for hard red winter wheat. Funds still short about 17,000 contracts or so of hard red wheat, and very similar looking chart. We rallied a dollar going into fall. Markets have now sold back into the 580 to 590 range. Probably still looking at that blue 200-day moving average line up around 630 as a place to target for some sales. Looking at spring wheat, similar again, funds short about about 17,000 contracts of spring wheat. And again, we rallied nearly a dollar into October, and now we've sold off much of that. And so, again, probably looking up, you got a double top around 655, a little bit below the 200-day moving average. That 6.5 level probably be a good opportunity to be selling old crop or the harvested wheat. And then looking ahead to next year, we're again making a new low. Today, I don't want to be a seller, but probably up around that 675, 680, 690. Probably want to start getting a little more aggressive, making some sales for next year. Finally, in cotton, the yield did not change in this month's report, 789 pounds, which is the lowest we've had since 2015. You can see USDA did a few tweaks by state, did lower the big one, Texas down about 5%, but that was offset with an increase in Georgia, North Carolina, Louisiana, Missouri, Oklahoma. Looking at production at 14.2 million bales. So the fourth out of 5 years where we've seen relatively low cotton production, although that cotton number was on the high end of trade expectations for the report on Friday. I think a lot of traders thought we would see another drop on the production side, and that did not happen. However, what USDA did do was cut the export number down to 11.3 million bales. That was down 200,000 bales again. And so we continue to fall short on the export side of things. A lot of that due to China, but ending stocks back up to 4.3 million bales. That's the highest we've been in several years. And so both U.S. and world stock numbers grew in the report on Friday. Now, all of the focus seems to be on China right now. China is going to be what gets us out of this demand conundrum that we're in right now. But the stimulus, as this report from the Wall Street Journal said, it's necessary but unlikely. And China's debt continues to grow. The spending isn't growing on a personal level. And so we're just not seeing that growth in the cotton demand that we were hoping would come from the Chinese. And so, yes, funds bought back a chunk of their short position, kind of like they did in some of the other markets, still sitting short about 6,000 contracts as of Friday's report. And so you can see that buying that they did gave us a nice little rally up into late September, up at 76 cents. And now we've kind of seen a sideways to lower trade. One thing I would point out today, all of these moving average lines from the 9 to the 100-day are all within a penny, which basically tells us we've kind of reached an equilibrium type price, kind of right in the middle from the August low back up to the September high at around 71, 72 cents. And so where do you go from here? If the demand ever shows up, a run back to 75, 76 cents would be what I would be looking for to sell the heck out of it. The 200-day moving average at 76 and a half, again, kind of making a lid above this market. So probably where I would be looking at right now. Looking ahead to next year, the chart looks similar, but we're a few pennies lower. This 200-day moving average at 74.6, probably a place to be looking at making some offers. Don't really want to get terribly aggressive, but if you're to get back up there, your indicator lines would probably indicate an overbought market. So, in that 74, 75 area, probably need to be rewarding with a little bit of a hedge for next year. So looking ahead to next year, well, USDA and a quieter report came out last Thursday and talked about their baseline projections for the next 10 years. Now, these were some of the numbers that they put out for next year. They were projecting corn acres to climb to 92 million, up 1.3. They were expecting soybean acres to be down 2.1, wheat acres to be virtually unchanged. And the impact that would have on their balance sheets, these are kind of a summary of their balance sheet numbers, but they're looking for corn production and stocks to grow. Stocks to grow over 2.2 billion bushels, average farm price at 390. Bean acres down, production down, ending stocks up to 515 million, and the average farm price at $10. Wheat, nothing really changing. Average farm price a little higher to 580. And then cotton, acres down, production up with a rebound in yield, but stocks basically staying about unchanged in price as well. So that's their earliest numbers. Keep in mind, these are not based on surveys. These are just based on economic numbers. So what are we looking at? Well, as far as producers go, this was from the University of Illinois. This was their return for next year on ground in Illinois, in central Illinois, on corn and or corn soybean rotation, and they're looking for the third straight year of negative return. Now, keep in mind these are based on their expenses, and I know a lot of producers tell me they're too high, but whatever the case is, it shows the definite change we've seen from where we had been just the previous 2 to 3 years. And so I want to introduce, if you haven't seen this, this is our Producer Profitability Matrix tool. This tool can be found in the agent portal on the NAU Country's website. Go there. We've got a list or another drop down with all of our calculators. Pull up this tool, and I want to show you some examples of it because I think it's a good tool to be able to help show producers different ways to utilize different crop insurance policies along with marketing to be able to try to generate enough revenue to hopefully cover cost of production this year. And so here's a snapshot of what this tool looks like. It's pretty simple, Excel-based tool. We've got a place in here for your state, your county, the individual APH on the farm, your expected county yield. I used an example for Champaign County, Illinois. The base price for the insurance, my individual coverage, do I buy SCO? Do I buy ECO? It's going to calculate then what the coverages are. Then on the right-hand side, my insured acres, my insurance premium, my farm expenses, and then my forward sales. Do I forward sell? What was the average contract price? So in this first example, I'm showing me doing nothing at all. I didn't buy any insurance policies, didn't forward sell. I got $1,000 an acre input cost on corn. And then the matrix at the bottom shows me 200 some examples of profit and loss in this matrix. And we've got yields across the top, both the county and producer. And then we've got harvest price on the left-hand side. And so you can see that at 450 corn, at $1,000 an acre cost, we can make a little bit of money, but boy, we got a lot of potential loss here if we lose bushels or yield. So we can look at utilizing first insurance to be able to protect that. What if I buy an 85% RP policy and that policy costs me $25 an acre? And that's just an estimate at this point in time. Now, that didn't really change a whole lot of the colors or the profitability. It did limit my risk to the downside. But what you can see with an 85% policy is that it's not going to be enough coverage to guarantee that I'm going to make money this year. And so that's why I think we're going to have to step outside the box a little bit to start looking at some other alternatives. The last couple of years, we've been able to utilize some of these additional policies and coverages to be able to guarantee a profit. This year, we're just trying to figure out how to cover our cost of production. So let's do one change to this. Let's go and say we're going to drop our individual coverage back to 80%, but I'm going to buy supplemental coverage option, SCO, from 80 to 86%. And the reason I might consider doing that is because it's subsidized 65%, more than my RP coverage is. So I'm going to be able to essentially add a percent of coverage for less money. And so it doesn't really change the colors in the matrix. It does raise my worst case scenario about $13 an acre, but it does cheapen up my overall cost of doing my risk management. So that might be something to consider. The next thing I might want to look at, though, to try to get more green on the screen is utilizing ECO. And if I buy ECO coverage up to 95, now I've got a county band from 80 to 95 on top of my individual coverage at 80. My premium went up. Now, one thing about ECO this year, it's going to make it really attractive is the 65% subsidy. The government raised that 21 points this year. That's already been done outside of the farm program. So doesn't matter what happens with a farm bill or not, that's already been approved. And so again, I didn't turn more boxes green, but I did limit my worst case scenario by almost $100 an acre. So now my worst case scenario is a loss of $57. So it wasn't quite enough to cover my expenses. Now, if my expenses are not $1,000, if we're 950, then it comes close to doing so. The other thing I can look at though, if I'm worried about this lower price, is forward sell. And so let's say I forward sell roughly a third of my expected production, about 75 bushel an acre at 450 corn. And now my chart looks a lot better. I mean, it's still not turning everything green. I've got some loss scenarios where the market didn't change. We just lost bushels, more bushels than we could cover with insurance, but I've got a better looking picture. And it's not quite as bad as the picture that Farm Doc put out, showing, significant red numbers here for this coming year. And so we can tweak this thing. One thing we might want to consider, and I'll talk about this in a minute, is possibly not doing SCO coverage on corn. Maybe you look at the county ARC program, being able to protect that one band of protection in the middle. If we have a county ARC program, though, right now we don't even have a farm program in place. So there's not a lot of things that we can do yet on that side of it. But I think as we get through the winter, things will become a little clearer on what we can look at doing this year. So I encourage you to utilize this tool. Gives you a real quick snapshot of the profit and loss opportunities for the farm using different kinds of protections. So I mentioned the government program. Friday's report, USDA changed two prices for this marketing year. They dropped the wheat price a dime to 560, raised the barley price a dime to 660. Keep in mind this marketing year does not end until the end of August, so we still got a ways to go. These projected prices, certainly for corn, were well below the insurance price last year. We're well below the ARC benchmark. So I would say that there's a decent chance in a lot of places around the country that there could be an ARC payment made for this marketing year, but we won't know that until the end of August 31st. That's when the marketing year ends, and so that's a long way down the road. But for the 23 year, these are maps that FarmDoc put out recently showing what the final payments would look like for this past year. Those payments, if they haven't been made yet, should be made soon. You can see that the biggest area was in Nebraska and Kansas, a little bit sprinkled into Missouri as well. For corn this past year, for soybeans, really focused again on that Nebraska, Kansas area, as well as some down in the Delta. And then in wheat, again, really focused on that Nebraska, Kansas, Panhandle area, some big payments out in Oregon as well. So that's what it looked like for 23. But, even though we saw prices go down, a lot of yields around the country were still pretty good. Now, this coming year, the question, first of all, is whether or not we'll have a farm program. But if we do have an ARC County program that's the same as what we've had in the past, then that base price or that benchmark price for the ARC County program would move up to 506 this coming year. For soybeans, it would move up to 1220, which right now is running way ahead of where the insurance price would be. These are in the green, it'd be December 25 corn, November 25 soybeans this morning. And so you can see even wheat looks a lot better. And so the county ARC program for sorghum, for barley, looks like a pretty good program this coming year if we're going to be able to have it. And so what I did was build this comparison sheet to be able to compare kind of apples and oranges, so to speak, because ARC County and SCO are very similar. They're both county level protections, both start at 86%. SCO is an insurance tool, and it's going to cover from 86 down to wherever your individual coverage is. In this example here, I showed down to 75%. ARC County basically will cover as much as 10% of the county's benchmark revenue, which in this case is $105.50. So let's look at SCO. Let's say that the insurance price ends up at $450 in February. Say we go down to $410 in the fall. I use 210 for my yield on my farm to calculate the dollars of coverage, and that comes out to $103.95 with an underlying 75% RP policy. Let's say that the county yield doesn't change. It's just a price only drop. We go down to 410. Do the math down below. We're getting $0 back because without a drop in yield, that 40-cent drop is not enough to get down to lose 14% of the county's expected revenue. So you would not trigger a loss. However, the county ARC program is going to, if we have it, we'll use a 506 price. And this is an example I ran for Wabash County, Indiana. Their 5-year expected county yield was 208 and a half. Same trigger, 86% as SCO. The only difference, one of the big differences is that Ark County is going to use 85% of your base acres. So for SCO, I said we planted 1,000, but for Ark, I said I only had 900 base and I only get paid on 85% of that. That's 765 acres. Well, we do the math. We ended up with final revenue. If the price ends up at 410 for County Ark, we end up with a revenue of 826, which ends up being an $82 payment. Which comes out to $62,400. So huge difference from what we would be getting for SCO. So this is why if we have the Ark County program or something like it, I'm certainly going to want to look at utilizing that to protect the middle part of my revenue band and maybe save myself a little bit of money there that I can utilize to cover that top end risk this year. Another program I do want to mention because I've read about it, it makes a little bit of sense, is that the Farm Doc Group put this out just recently talking about market year revenue. And it's very similar to County Ark. It uses a 5-year Olympic average price and a 5-year Olympic average yield. However, the yield is a national yield. The price uses crop insurance prices. So we use the February and the fall price. And the nice thing about that is that they're using the fall price, which gets set in October, and they're using the national yield from the October crop report. So by the 1st of November, you'll be able to know whether there would be a payment for the MYR program versus the current Ark County, you got to wait a whole year before you would get a payment in November the following year. And so this also uses the 5 most recent years because the prices get set quicker rather than using the whole marketing year as an average. And so they went back and back tested, and if we'd had this program in 2024, the payments would already be made right now. $40 for corn, 28 for sorghum, 0 for beans, 77 for cotton, which we won't know for another 8-9 months before we'll know whether or not we might get an ARC payment for the 24 crop year. For 25, based on what USDA is currently projecting, based on where prices are looking at right now, you'd be looking at a $77 payment for corn, et cetera. So I think that this bears watching if and when we get the ag committees together again in the House and the Senate. If they decide to start talking about farm programs, I think that this is an alternative that bears watching. So it's an interesting alternative, and I think it might be a good one for us. So crop insurance, where were we at for 2024? Well, we just finished the pricing window here at the beginning of the month. The corn harvest price averaged 416 in the month of October. That was down 10.7% from where the base price was at. You can see all the other prices across here. Sorghum at 417, soybeans at 1003. And you can see the percentage losses across the bottom as well in the red numbers. And so any of these numbers in double digits, some of these higher coverages, whether it's ECO or stacks for cotton, probably have a decent chance to pay based on a loss from that February to that October price. And so if you went back last week, if you get the market report letter, I spent a couple of days kind of recapping how these programs would work with our tools. But this is the indemnity worksheet for SCO and ECO. And I just looked at ECO coverage last year at a 9% band from 95 to 86 on corn. Said that we knew we had a 50-cent drop in the price. Would it trigger an ECO payment? Well, for this example, I suggested that the yield in the county didn't change. We stayed at 200 bushels. And if it's just price only, then we ended up at revenue at 89.3% of our expected revenue, which is below the 95 trigger by 5.7%, which means we get paid 63% of the band. We would get a check for $53.10 if that county yield comes out unchanged next spring. But then the matrix on the next page will show you a number of different examples. And so I plugged in the price unchanged at 416 now and looked at 2 bushel increments and all the way up to 212 bushel an acre in this county, or 106% of our base expected yield, we would be triggering some sort of an ECO payment. So I think majority of counties that had ECO this year probably will trigger at least some money. If your county yield wasn't up at all, you're probably looking at getting quite a bit of money potentially back with the ECO program. For soybeans, we even had a bigger percentage drop. So it turns out that we ended up at 86.8% of our expected county revenue. And I'm assuming that the county yield again didn't change just based on the drop in the price from 11.55 to 10.03. So that's an 8.2% loss from the 95 trigger, which is 91% of our band of coverage, which pays would be $56.82. Go to the next page, we can look at a number of different scenarios, and all the way up to 109% of our expected county yield would be triggering a little bit of money back for the ECO program on soybeans. So I think majority of folks that bought ECO on beans this year probably be looking at getting some money back as well. Now, switching over to margin protection insurance. The drops in margin protection were even greater percentage-wise because we started at much higher prices last September. Therefore, the corn ended up at 18.2% loss, soybeans down 22.6, wheat down 28% loss. And so at a 95% trigger, you'd have had to have a heck of a county yield not to trigger a payment. So again, if you go back and look at our worksheet, just doing the math with an unchanged yield in any county, let's say we started with a 200, we ended at 200, but because of the 95 trigger, because of the 120 protection factor, because of the drop in the price, we're looking at getting $147 an acre. And then the matrix down below is going to show you a lot of different scenarios and all the way up to a 14, maybe even a 14.5% increase in yield would still trigger some sort of a loss and a payment this year for margin protection. And if we're at 100%, like I said, 147.02. For soybeans, again, because of the drop in the price from 12.95 to 10.03, you could have a county yield 22% higher than expected and still be getting a little bit of money back this year. So it's going to be a while before we know what the county yields are going to look like. Some states will put NASS report yield numbers out in February. So we'll be looking for those to at least get an idea. But again, we use the crop insurance yields that come out after the production reporting deadline at the end of April. So it's going to be still a few months before we know exactly what those dollars would look like. But the point is that those policies did what they were supposed to do. They protected against the drop in the price that we were fearing could happen. And it looks like they're probably going to reward the buyers here this year. The last item I want to talk about on crop insurance is PRF coverage, pasture, rangeland, and forage. Basically, it's a rainfall protection on those acres that you got into pasture and forage ground. The deadline to add this for next year is December 2nd. And you buy basically a 60-day interval or 2-month interval. So you can buy the Feb, March, July, August, whatever interval you want to buy. And we've got some tremendous information in our software to be able to show you historically which intervals tend to be able to trigger the most often. Where do they get their data from? NOAA's got reporting sites all over the country. We got a really thick map in a lot of places, so there's a lot of different gauges, and these numbers have become very accurate over the last several years. But the number of insured acres, I mean, we're bumping 300 million acres now. So it's really changed a lot in less than 10 years. We went from 50 million to 300 million acres. So if you've not done PRF and want to know more about it, certainly give your agent a call. They can get you information on how to be able to protect those basically against lack of rainfall. So what's coming up? Well, November 28th is Thanksgiving. Markets will be closed that day. The 2nd of December is our PRF deadline. We'll have our next WSDA report from USDA in early December. The following business day, we'll have our aftermath, talk all about that report. Then we'll have Christmas on the 25th of December. Markets will be closed that day. January 10th is our final production report for spring crops. So they'll incorporate those numbers into the WSDA numbers, and we'll talk about it at our aftermath webinar then on Monday the 13th. So a lot coming up. We've got some market closures with the holidays. So expect some kind of bouncy trade, especially with the now that we're also in that period between the election and January when the president takes office. So a lot of speculation of what's going to happen between now and then. So it looks like volatility is kind of sticking around here for a little bit. So don't forget, if you'd like to sign up for the opening bell phone call, the market report email, you're welcome to do so. Please let me know. We'll get you hooked up. With that, again, thank you for all the veterans that are listening today. We appreciate so much your support of this country and the service that you've given us. And with that, take care. We'll talk to you again very soon.